All right, so if you go on the bottom left,
Oh yeah.
one attendee so far.
Yep.
Oh, here's a few more.
Beautiful. I wonder if we'll ever master this virtual.
You shouldn't say that because we're live and everyone can hear us.
Yeah. I mean, in terms of just everybody being on time.
It's probably a lot easier to get to a virtual event than it is driving in the wintertime and parking in the West Loop.
That's
right?
true. I definitely don't miss that.
Yeah.
So I actually did have a question from a client yesterday that probably is next level for anybody listening, but they're a physician, Justin, and they are thinking about doing a physician's loan, but they are wondering that once they start making more money, as you know, they'll, as they get more into their career, they will do so. So they were wondering if they could refinance and then do a different loan in the future after initially doing a physician loan.
You can always refinance no matter what.
Okay.
No matter what type of loan you took out. The physician loan is geared towards potentially high earning physicians that have been in school for 17 years that haven't had enough time to make money yet. So they get a very low down payment option without being penalized, with the assumption that they're going to get a great paying doctor job. But those have kind of tightened up too with everything going on.
Yeah, that makes sense.
It's not like a less desirable loan. It's actually a pretty desirable deal because they don't have to put as much money down.
Yeah.
So, all right, looks like we got a few people in here. Maybe give it about 5 minutes. It's just 6:30 now.
Yeah, absolutely.
So how long are you guys going to be down in Florida for?
Just a few more days. I'm here with, the in-laws. So
got it.
We're here temporary, Chicago, we love it, but yeah.
Assuming you flew?
Sorry?
You guys flew?
We drove.
Oh, you drove? Okay.
Yeah.
How was that?
I love driving, so for me it's
fun.
Yeah. Walk in the park.
Yeah.
Jen helps me answer emails and stuff while I'm driving, and I just go. So yeah. We'll see how it. We'll see when we come back. It'll probably be before the end of this week. Week.
Jen gave you a thumbs up to your email comment.
Did she? Beautiful. Yeah. She's great. I don't know what I would do if she wasn't helping. On the lending side, what are you seeing in terms of I know a lot of banks are tightening up, and I know this is probably too in depth for 10 seconds into a seminar about home buying, but
yeah, I mean, things are, for the first 30 days, it just got crazy with unknown kind of just what was going to happen in banking, and then everybody had to go remote. And so it was kind of a weird transition, and then literally the rates dropped to the low threes and half the country tried to refinance at one time.
Yeah.
So it was just like a combination of 5x the demand that banks are typically, equipped to handle, plus the entire world working remotely. So it just really created a big traffic jam. And so that was the initial, turbulence. But since then, we saw jumbo loans tighten up a little bit. Everybody was bumping up the down payment on those. We dropped ours down to 10% on jumbo loans from 20. And, employment scrutiny. People have been losing their jobs mid-transaction or going on furlough.
Yeah.
So there's some employment scrutiny, but like Chase and Wells Fargo and all those big banks, they went hard, 20% down, 700 credit score, no matter what.
Yeah, I heard that. I was actually curious about your input on that because I've heard there was a few people mentioning that they think that's because the big banks just hate doing mortgages in general. So it was like an easy way for them to get out of it. I don't know if you think that's.
Yeah, I mean, it's a combination of, banks want money. They want to take your money, CDs, deposits, money markets. They don't like giving money, right?
Yeah, fair.
So when you factor in the risk of lending coupled with the pandemic and, you got like unknown economic circumstances, massive unemployment rates, it's a perfect storm. And then the government's going to force the banks to let people not pay their mortgage for 6 to 12 months.
Yeah.
So it's just like a lose-lose. So they wanted to basically shrink the box as small as possible. And big banks, big banks that are like national lenders, they have a global outlook. I mean, they have investments and, they're multifaceted, right? Whereas guaranteed rate, we just do lending. So big banks could see disruption in other pillars of their kind of financial world.
Yeah.
And they think that there's going to be more downturn in the next 12 to 24 months. So they want limited risk exposure, like residential lending's high risk.
Yeah, that makes sense. I'm curious I wonder what they think about commercial, but
commercial's high risk too, man. I mean,
yeah.
I think a lot of industries are not going to recover.
Yeah.
And I think a lot of companies are going to revisit the need for space because a lot of industries are running just fine with their employees working from home. So it's like, if you send everybody back to work in a cubicle, what do you have to do now? You have to germ proof and put up plexiglass and basically build like hamster cages for everybody because there's going to be all these, safety regulations.
Yeah.
So,
no, it's not a dull moment these days. So.
no. Okay, looks like everyone's kind of trickling in here. Maybe give it another minute or two and then we'll start.
Yeah, that sounds good to me.
All right, hopefully you guys are enjoying our commentary here.
It's pretty boring so far, but yeah, maybe somebody is big into the lending world.
Could even be a good time for a poll question.
True.
What do you think about a poll question?
I'll let you take the reins on it.
All right. So we're gonna pop up a quick poll question for everyone that's logged on here, and the question is: on average, how much do renters spend before purchasing a home? So I'm going to share this. Can everyone see this question? Jeff, can you see the question yet or no? Okay, let me share it. Here it is.
I'm embarrassed to admit that I don't even know the answer to this question. So,
because you're a homeowner.
Yeah, true.
All right, looks like almost everybody's answered here.
Is this do you know if this is nationwide or Illinois specific?
I think this is a general nationwide question.
Yeah, makes sense.
Wow, 2 people guessed $500,000. Some expensive rent.
Yeah, I'll vote too if I can.
Ashley said that they can't hear us anymore. Can everyone else hear us? Can you guys hear us? Give us okay. Yep, crystal clear. Okay, maybe while the poll was up, maybe not. All right. Okay, should we get started here?
Should we tell them the answer, or are we gonna build the suspense?
Well, the answer is somewhat circumstantial, but it is actually about $100,000. So 2 people got that right. If you figure you're renting a place for, in your early years, maybe a little bit cheaper, and then some people get up to about $2,500 a month, which is about 30 grand a year. So a couple of years at that, you can get to 100 grand pretty close, but on average, it's about $100,000 before purchasing a home. So interesting stuff.
Yeah, that's right.
All right, Jeff, you want to kick it off?
Yeah, absolutely. Well, thanks for everyone joining us tonight with Let's Buy a Place. I am Jeff Zurikat with Compass. This is my preferred lender. I'll let you introduce yourself.
I'm Justin Lopadna with Guaranteed Rate. Hi, everyone.
So real quick, we'll go over the agenda for this evening. First, we'll start off with why you're all attending this event. From there, we'll go through a rent versus buy scenario, which many of you may be able to relate to buying your first property. Then this will lead into what the benefits of home ownership are. We'll discuss when you shouldn't buy a home, and then we'll go through the step-by-step process of what buying a home in Chicago looks like. And at the end, we'll open it up for a Q&A to answer any questions you guys might have about lending, real estate, or I guess we'll see where the conversation takes us.
Sounds good.
So first, why are we here? I'm sure we all have different reasons for being on this call, but the main reason is that buying a home is usually the biggest financial decision you'll make in your lifetime. And I imagine many of you are trying to learn as much as you can about it beforehand, so that way you're well equipped to make that decision. So that's what Justin and my goal is tonight, is to give you as much insight as we can about the ins and outs of buying a home in Chicago, and hopefully you'll be in a better position to do so. So for now, just sit back, relax, and then any questions you have, feel free to put them into the chat. So we'll start off with why you shouldn't buy a home, because we want to be completely transparent with you. When it comes to buying a home, not everybody should do it, especially right now. One reason might be if you are planning on moving in the next couple of years. When you factor in the cost of buying and selling a home, it can get expensive. So if there's a good chance that you might be moving in the next 2 to 3 years, you might actually be better off just renting. Another reason too that is very applicable to the current environment is if your job security is unknown. If you think there's a good chance that you might have your pay reduced, or even, God forbid, you get laid off, then the last thing you want to do is buy a home and then have that happen. So if that's something that you're thinking may be possible, then maybe it's better to wait until things are more stable.
Yeah, I think that's 2 great reasons, Jeff. And as Jeff mentioned, the home buying process is a journey, and timing is important. Life timing, financial timing. Some people come out of college and they might start a business where their employment is a little less stable. Some people, may have had some type of previous derogatory financial situation, a hardship, maybe a divorce. And so sometimes the credit or the income or the savings is not there. And so, everybody is not ready to buy a home, but hopefully we can give you guys some good education on how it works. And, it's up to you to figure out if the timing makes sense.
I'll let you introduce everyone to our good friends.
So these are 2 really good friends of ours. Their names Will and Kate. Jeff likes to hang out with these 2 guys a lot, especially during the shelter in place here. And they're a nice young couple in Chicago, and they're thinking about, should they rent or should they buy?
So just as Justin said, I know them pretty well. So to give you some backstory, they are currently renting a 2-bedroom loft in the West Loop. The rent is $3,000. That includes a parking spot. Will commutes to the suburbs for work, or at least he used to. So they need the parking spot. They have amenities. Unfortunately, they don't have any pets. I know Kate has been really pushing to get a dog, but Will has been resistant. So, and their landlord doesn't allow them. So that makes the decision a little bit easier. And I was talking to them recently. They've been locked up for the past 2 months, and they went on a walk this past weekend and they saw a for sale sign, and it was for a 2-bedroom, 2-bath loft in the West Loop as well, with a heated garage parking spot included. It's pet friendly, so if they wanted to get a dog or a cat, they'd be more than welcome to do so. It's roughly the same square footage, and it was listed at $420,000. So Justin, after seeing the home, what kind of questions would they have in terms of financing?
Yeah, absolutely. So, we talk to first-time buyers all the time, and especially now, there's so much misinformation. The lending world is having some constraints through the pandemic. So people are usually asking, first of all, how do we get a loan? I'm not sure we have enough money for a down payment, and it's, how expensive will it be compared to what we rent? And so this is actually a really good time to pop up our second poll question. So I'm going to post this up right now. And so the question is what is the minimum requirement for a down payment? So we'll see how many people get this right. All right, so it looks like everybody popped their answers in. That was fast. And three of you got it correct. It is actually 3%, believe it or not. I think a lot of realtors are surprised to hear that these days as well. But Fannie Mae, so the government basically oversees and regulates lending, Fannie Mae and Freddie Mac, and they still offer as little as 3% down for first-time home buyers. There are some restrictions. There are some income requirements. The average first-time home buyer last year put down 7%. So that was a national statistic. So a lot of people ask me, do I need 20% down? And the answer is no. Most people put between 5 and 10% down because young first-time home buyers, and not that you have to be young, but most first-time home buyers that might be under 35 might not have had enough time working to save money. They make enough money to support to afford the payments, but not everybody has saved up 20%, nor do they want to break the bank and put a massive down payment. So the average first-time home buyer last year put just about 7% down. So good job for those of you that got that right. So what makes up your mortgage payment? So a lot of you have probably heard of these terms. Just to do a quick review, you have your property taxes, right? If it's a condo or a townhome, you'll have homeowner association dues, also known as assessments or HOA fees. The assessments can include things like amenities, some insurance, some cable. So as you see, high rises might have really expensive amenities because of the maintenance, because of the amenities and the doorman. And low rises in certain neighborhoods have very low HOA dues. So it's important to understand how those variables shift. There's also going to be some homeowners insurance for flood, theft, and fire. And then the last factor is PMI, so private mortgage insurance. Many years ago in our parents' generation, PMI was very taboo. It was very expensive. And so that's why everyone has this misconception that you need 20% down. In the current lending world, PMI is very affordable. It's not very expensive at all. It does change based on your loan size and based on your credit. It's just like car insurance, except it's for your home. It's like home insurance. In case you default, the bank needs you to be insured. So there's 4 components on top of your mortgage payment that equate to your entire monthly overhead. That being said, what we did was we ran a scenario where Will and Kate put down about 10%, and we kind of mapped out the payments. So as you can see in this breakdown, and for those of you that may have a pamphlet, you can see that there's their principal and interest at $1,671, their monthly property taxes, which they pay with their mortgage monthly, their HOA dues, homeowners insurance, and PMI. So with 10% down on the $420,000 purchase price at a 30-year fixed rate at 3.375, their total monthly payment is about $2,868 all in. So what we did was we broke down 5%, 10%, and 20% just to give you an idea of how increasing your down payment can lower your mortgage payment. And a couple details to note here. Number one, you do not have to put increments of 5% down. It's important to know that there is no exact down payment requirement after you hit that 3 or 5%. So we do give the 5, 10, and 20% option just to give you perspective, but the goal is to really find equilibrium. We want you to put enough down payment to kind of get your mortgage payments at a comfortable level so you have this financial stability. And our job as your mortgage lender is to kind of help you strategize and think through what's comfortable from an out-of-pocket side and where you need your payment to be and kind of find that equilibrium. So these are the 3 payment examples. As you can see, 20% down gets you down to about $2,500, and putting 5% down keeps you closer to about $3,000. So there's a big swing there. So what we did is we compared the annualized expenses at 10% down, which kept the payments right at about $2,868 versus $3,000 a month. And you can see how much over the course of 1 year Will and Kate would spend compared to what they would spend renting. So interesting. And then you multiply that over 3, 4, 5 years, you can easily get to $100,000 plus. Jeff?
Yeah. So in terms of obviously there's the benefit of paying your own mortgage versus your landlord's, but some other additional benefits are, one, that you can deduct the mortgage interest from your taxes. So if you itemize your taxes, you can deduct the mortgage interest. In addition, each month you're going to be paying down your mortgage and your principal. And the theory is too, is that as your property appreciates, that will be additional money that you can see in the future. So between paying down your principal with the appreciation in your home, that's a great way to build equity. And it's also a great way to build wealth for the future. But it's not all financial. There are additional benefits to buying a home. There's the emotional benefit of doing so. So for many people, especially young buyers, their parents are very happy. So, that's a bonus for some. But also if you're starting a family, if you just got married, it's an exciting time to start your new home and your new future with that person. So there definitely is an emotional component to it. And you also have the freedom to customize. So I'm sure many of you who are renting have come across the issue of, if you want to paint, if you want to change light fixtures, if you want to do anything really, you need to get approval from your landlord, no matter how small it is. With your own home, you can put in new kitchens, new bathrooms, you can paint the cabinets, you can do pretty much whatever you want, as long as it doesn't jeopardize the condo building or violate any zoning laws. So
Can you put a big billboard on top of your roof? Derek Pett, #1 realtor.
We could definitely look into it. But yeah, so there's definitely a lot of benefits to owning a home outside of just the financial. So now we'll start going down what the process looks like when you're buying a home in Chicago. So the first step is to find a realtor. The key thing with any realtor is that you want to find somebody who you can trust. As we discussed, it is a very big decision, and you want to make sure whoever you're talking to, they are going to be looking out for you in the long term, and not just trying to sell a home. For me personally, I used to be a big fan of getting coffee and going through everything over about an hour chat. But obviously with the current circumstances, I've been doing a lot of Zoom calls, phone calls, and hopefully one day we'll be able to grab that cup of coffee. But the key things that I would tell you at that meeting are to start looking around 3 to 6 months before you plan on buying a home. It just gives you enough time to really hone in on what you're looking for, familiarize yourself with the market. During that meeting, we will discuss what neighborhoods you're looking to be in, what size home you're looking for, what budget. Make sure that that's something realistic that you can find. And then we'll go over anything that you must have. And honestly, as you see homes, those will probably change, but at least we can get started. And then that's what the 3 to 6 months allows you time to figure out what really is important versus what is just a wish list item. And the benefit to you also is that when it comes to fees with a buyer's agent, there are no fees. All the fees are paid by the seller. So it's completely free for the buyer. And then once we've had that meeting, that's where I'll put you in touch with Justin, and I'll let him fill you in on the next step.
Absolutely. Thanks, Jeff. So, it's important to get pre-approved. As I mentioned earlier, when it relates, as it relates to the payments, as a mortgage lender, we want to make sure you can comfortably afford your mortgage payments. We want to make sure you're educated on, what price point equates to what monthly expense. So if I'm spending $300K in Wicker Park, what is my monthly payment going to be versus $500K in the West Loop? And the 3 main components that we look at are your income, your credit, and money for a down payment. So what we're going to do is we're going to talk through some financials. We're going to figure out how much you're looking to spend. And again, the main goal is to make sure you can comfortably afford your payments and that you're prepared so that when it's time to really begin the search with Jeff, there's alignment. If you want to keep your payments at $2,500 all in, we shouldn't be looking at $600,000 homes in River North with HOAs at $900 a month. So we're going to help make sure that you're efficient in your home search. So when you do find a home you love, you know that it's within your budget. Once we get you pre-approved, it's kind of really, time to begin the search. And Jeff, what does that process look like?
Yeah,
with home buyers?
Absolutely. So yeah, once we have that pre-approval from Justin, that's where we have those guidelines and we can really start looking at homes because we know what budget you want to be in. We know what HOAs and everything that he just mentioned. So what we'll do is I'll send you over all of the listings that I think are the best fit for you within your budget. And an important distinction is there's a ton of homes you can find on Zillow and Redfin. But there's also, especially right now, inventory is historically tight. And there's a lot of homes that are available to purchase, but you won't find them on major websites because they're considered off-market listings, whether the seller doesn't want to be on the market because of COVID, or they're just not sure about whether they want to sell right away. There's all this inventory that won't show up. So I'll send you anything that I see on the private networks as well. And then from there, we'll schedule a time to go see your favorite ones. During the first few showings, I'll educate you on things that I'm looking for from a real estate perspective. So I'm always looking at resale. I'm looking at any potential issues that I could see in the future. And then as we see more and more, the goal is for you to know as much as I do. And then, it's almost like a team effort where we're looking for that perfect home together. And and then hopefully there's that one showing that we go on where you'll turn to me and say, Jeff, I love it. I want it. What do we need to do to get this? And then that's where we'll write up the offer. So writing up the offer is exactly as you would probably imagine. Obviously, we'll talk about what price. I'll run research on all the recently sold units in that area that are similar, try and figure out what I think the home is worth. We'll come up with a strategy. We'll want to discuss what closing date you want to do. So I know many of you have probably heard of closing dates. To clarify, that's the day that you actually take possession and become the owner. So what we'll want to do is find a date that is convenient for your schedule, but also we need to make sure that it is appealing to the seller and see what their timeline looks like. Some other pieces of the offer that will be considered are how much earnest money you're putting down. So when it comes to earnest money, Justin loves saying it this way, that it's your financial commitment to the contract. And in essence, it's your collateral. So when you make the offer, you're also going to say, we're willing to put down this much as earnest money, showing that we're this much committed. So the more money you put down as earnest money, the more serious the sellers will believe you are. The less money you put down, then it makes it that much easier for you to walk away if you change your mind. And then, we'll also want to talk about the inspection, whether an inspection is necessary. Sometimes if people buy new construction, it might not be worth the cost of having an inspection. I'm always an advocate of doing it. You never know what a professional might find, but that's also something that if you waive it, a seller will definitely appreciate and will give you a little bit more leverage. So we'll probably do a couple back and forth discussions with the sellers, and then hopefully we get that call where they say, you have a deal, congratulations, and they accept our contract. And then, as I mentioned, that's when you will deposit your earnest money. And then one quick thing to add in there, in Chicago, it's very normal to have two different times where the earnest money is due. So we call it the initial earnest money and then the final earnest money. The initial earnest money is due when the contract is accepted. The final earnest money is due in a few steps, which I'll clarify. So then this will lead us into the attorney review and the inspection period. So shortly after the sellers have accepted your offer, you will want to hire an attorney to represent you and an inspector who will go through the home and check every nook and cranny to make sure you're aware of anything that you need to know. For me, I have a few different inspectors and attorneys who I can recommend, but we can always talk about if there's somebody else that you want to use. We can discuss if they're a good fit for you. The inspector will research everything. They'll discuss the items that you want to bring up to the seller, and we can always negotiate any inspection items that arise. With the attorney review, something that many first-time home buyers aren't aware of is if you're buying a condo, there is a whole series of documents that will outline anything that the condo association has been discussing. So those will be documents that we'll want to review and also discuss with your attorney in case there's any big projects coming up or if there's a litigation against the building. These are things that you want to be aware of, especially from a lending standpoint, because I know Justin would be very unhappy if we did not mention a litigation in a building, but that's probably getting too deep into it. Once we've negotiated all the inspection items and come to an agreement, that's where Justin will take the reins again.
Yep. So just to kind of summarize all that, that was good information. Let's assume there's a 45-day closing window, right? So if someone goes under contract today, they're targeting closing around right after the 4th of July, just to use some realistic dates. The first week or so consists of the attorney review and inspection period. You guys are going through this inspection report, making sure the property's in healthy condition. There are three main stages of what I call risk mitigation. The first one is your inspection. Is the property healthy, in good condition? Are there any repairs down the road? Once your inspection's done and you're ready to move to step two, that's when we step in as your lender. We go, okay, guys, you're under contract. Congratulations. We talked about putting 10% down and doing a 30-year fix. Here's where the rates were last month when we spoke. Here's where they are today. Here's what your payments are. Are we still doing a 30-year fix? Are we still doing 10% down? So we tighten up the numbers, finalize your loan term, get the paperwork going, collect any updated financials. So while you may be working through the inspection items or kind of finishing that up, we're simultaneously beginning the loan process, which is stage two of risk mitigation. We need to make sure that the home's in good condition. We need to make sure that you still qualify, which you should if we pre-approved you. And then the third piece of the loan application process of getting your loan approved is the appraisal. So if you're paying $420,000 for the home, we have an appraiser come out to make sure the home is worth $420,000 or more. And that way we know that you're paying fair market value. So those three stages all kind of lead up to what's called your mortgage contingency date, which is when your loan needs to be approved, your mortgage essentially needs to be finalized, and at that point, more or less, it's the point of no return. So if you're doing a 45-day close, you have about 3 to 4 weeks to get each stage of the process completed, so you eventually meet what's called the mortgage contingency date, and you've satisfied what you committed to in the contract. You want to add anything to that, Jeff?
The only thing I would mention is from a listing agent or a seller's perspective with the mortgage contingency, it depends on how long of a closing you're trying to do. But let's say you were doing a 60-day closing. The sellers will probably want that contingency to be done as soon as possible, usually, 40 days?
In the first 30 days, usually 30 to 45 days. Yeah.
Yeah, they'll want to make sure, just because if something changes, if that contingency falls through, or let's say something changes with your job and it's not cleared, then you could
have the right to back out. Yeah. You have the right to back out, and nobody wants a surprise. So if you're closing on July 10th, nobody wants to find out on July 7th that you don't qualify or that something popped up. So if you're closing on July 10th, we're probably going to have a June 30th mortgage contingency, or maybe sooner, so that we know that after June, everything's been done. There's no issues. Now we're just waiting for the closing to be scheduled, and not kind of a mad dash to the finish line with uncertainties.
Yeah, absolutely.
Make sense? So we get your loan approved. Oops, sorry about that. We get your loan. Jeff, we're playing. So we get your loan approved. We get the appraisal done. We get everything ready. We meet the mortgage contingency. Now we're approaching the closing date, and Jeff's going to take you through those final stages.
Absolutely. So once everything's been signed off by Justin, now we're just waiting for the final walkthrough, which, as we just alluded to, it could be a matter of days or it could be a matter of weeks. It's almost like a dead period where not much happens. You're just waiting. But usually we'll schedule the final walkthrough as close to the closing as possible. So one piece of advice that I would give is, with a final walkthrough, if there were a lot of inspection items that came up and that were negotiated to be repaired, then I would usually recommend that the final walkthrough be done the day before the closing. The reason is that if we show up to check to make sure they were done and there were items that were not addressed, the last thing you want to do is have the closing in 1 hour and now you're scrambling to get this work done. But on the flip side, if there were no inspection items, or maybe the seller just said, hey, I'll give you $1,000 and you can fix it yourself, then usually it's appropriate to schedule the closing an hour before, or schedule the final walkthrough an hour before the closing. So that way we can go straight from the final walkthrough to the closing and not, waste any of your time. But yeah, once, if everything checked out at the final walkthrough, make sure that they didn't damage anything, make sure that they upheld their end of the bargain. We'll go to the closing. The closings look very different nowadays, but essentially you'll be signing loan documents. You'll be signing title work, deeds, re-signing things several times. And then at the very end of it, if everything goes smoothly, you will be the proud new owner of a home. Historically, we used to all stand around and hold hands in the air like Will and Kate. Now we do an awkward elbow bump and
Or Zoom high five.
yeah, or we just don't acknowledge each other and leave. But we'll see what happens. But yeah, so the closing, you'll get the keys to the home, and then you will officially be the owner of that property.
So Jeff alluded up front to the real estate services being, complementary. In other words, Jeff's compensated by the sellers, but there are closing costs that every buyer pays. The lending industry is regulated. Everything's pretty black and white. In other words, every buyer pays the same fees. Every seller pays the same fees. They're somewhat standardized. So you can see a list of the general closing costs, kind of, details that are itemized. The reason it says 2 to 3% is because if you buy in Chicago proper, your address is 123 Damon, Chicago, Illinois, you will pay a little bit closer to 3%. If you buy outside of the city of Chicago, you will pay closer to 2%. So Chicago has a slightly higher transactional cost. But these are some of the various fees. You'll have an inspection, an appraisal, you need some insurance. You have an attorney, which we didn't touch on, but we will in a second. There's a fee to work with the lender. So we do what's called underwriting and processing, which is kind of facilitating the loan from beginning to end. And then there's also the property tax stamps, which is another way of saying tax. So Chicago, Cook County charges every buyer and seller basically a sales tax. The sellers eat the lion's share of the costs. Average real estate commission is 5%. So the sellers are paying closer to 6 or 7% all in. Buyers are paying between 2 and 3% all in, for a total of anywhere 9 to 10% transaction cost. So as Jeff mentioned earlier in the process, it does cost a significant amount of money to purchase a home, which is why if you plan on moving in 1, 2, or 3 years for whatever reason, you might not recoup your costs. Jeff, when we were doing these last year, we would generally tell people, hey, you should be in your home for at least a good 3 years for you to pay down your balance enough every month. You're making payments, building equity, where you've already surpassed the amount of money it costs you for the transaction. If you think you're going to move in less than 3 years, it might be difficult to recoup the transaction costs. You still agree with that statement?
Yeah. To be honest, I've actually extended it a little bit further, where I know most agents still recommend at least 3. I've been advising my clients to do at least 4 years, frankly.
Yeah. Right. If you have some massive jump in equity, or some of these neighborhoods just kind of take off, right? A Bucktown, a Logan, some of those are still kind of taking off. Whereas you buy in River North or West Loop, you're going to pay fair market value, but you're going to be in a very stable market where your equity is going to come from you paying down the balance. Yep. Some neighborhoods, your equity comes from appreciation as the markets continue to grow and just, improve.
Yeah, absolutely.
So that's how the closing cost piece works. One super important element here is your support team. So Jeff, I'll kind of give my 2 cents and you can chime in.
Yeah.
What's important to know is that as a buyer, at some point, everyone's going to be a first-time home buyer. You don't know what you don't know. So Jeff's job is not just to find you a home. His job is to educate you. My job is not just to get you a loan. My job is to prepare and educate you, help you strategize and make sure that there's no pitfalls, to make sure that there's no blind spots. The third piece of the puzzle on your support team is an attorney. The attorney is with you when your contract is accepted. They review the inspection. They help you negotiate details. Myself, Jeff, and your attorney communicate behind the scenes and literally help project manage a transaction from beginning to end. So there's no turbulence, no surprises, and more importantly, so all your best interests are looked out for. So it's in our opinion very important to have people that know each other, that have a good reputation, and that work with each other so that communication is fluid. Because when you think about the number of people in a transaction, there's a buyer and a seller. They each have a realtor and an attorney. That's 6. Then you have a lender, an underwriter, an appraiser, an inspector, an insurance company, a title company, and probably 3 or 4 other people that are bobbing and weaving in and out. So in order for a transaction to go smooth with clear communication, it's super important to have just a quality team behind you. Jeff, I see you smirking over there.
Yeah. It's yeah, no, I couldn't agree more. It really, especially from the home buyer standpoint, if you have a good team working together who all operate, who are responsive and know each other, it just makes things go much smoother for everybody involved. And yeah, I'd probably say the most important advice I would have when it comes to the support system comes with the lender. And this isn't meant to be a plug for Justin. It's genuinely how I feel. I strongly recommend working with a local lender to the area you're trying to buy in and not using one of the big banks. Just because the big banks aren't as efficient. And I don't want to throw out any names for a big bank, so let's just make one up. Let's call it Wells Fargo, and it's usually much funnier in person. But
people are laughing. Don't worry, they're all laughing right now.
But yeah, I mean, honestly, Wells Fargo, I can't tell you how many horrible experiences I've had, and a lot of the big banks, they're just it's a different. I don't understand the back end process as much as somebody like Justin would, but they're just not as efficient. And as you might have heard when we were first talking, you actually have a lot more options with a lender like Justin when it comes to financing, because apparently Chase and Wells Fargo won't take a jumbo loan, whereas Guaranteed Rate will do it. Did you say what, 10% down?
10% down, yeah. Right now, Chase, Wells, B of A, all the big banks, no matter what your price point is, 20% down, 700 plus credit, or you can't get in the door. So most first-time home buyers put down 7% on average. So it's very difficult now because they have a very risk-averse perspective on what's going on, and they'd rather not lend than lend with loose parameters. So big banks will pull the rug out from under you, because when they make a decision, it's a national decision, and they don't care whose deal's in contract and how many people get impacted. Literally, we get calls probably a couple a week where a realtor calls us or an attorney calls us and says, so-and-so just got denied at B of A. So-and-so just got denied at Chase. So-and-so just said they need to go from 5% to 20% or they can't close. And we literally take the deal, restructure it, and kind of put it back on the assembly line, so to speak. Especially now, there's just so many constraints. So not to throw anybody under the bus, but Guaranteed Rate as a lender, all we do is mortgage lending. We don't do CDs, checking, savings, investments, money management. We do one thing. We work directly with the government, and we have a very fluid system, whereas a lot of big banks are just very risk averse right now. So yeah, I think that's super important. Jeff and I both know great attorneys, great inspectors. Some of these ancillary pieces, you can choose who you work with. And again, part of having that team is making sure you have the best kind of players on your team. I think that pretty much wraps it up. We'd love to field some questions. Feel free to, type in your questions in the message box. What I will tell you is there's a lot we didn't cover. It's very cumbersome to kind of go through an entire process from beginning to end. But the goal here was to give you some good education, to really make sure that you're on the right trajectory as you think this through. A lot of people 2 months ago were saying, no way, I'm not buying a home this year. And the market was very slow. And Jeff, you let me know, but in the last 3 to 4 weeks, we've seen a huge uptick in demand. We've seen people start to kind of come out of that phase 1 of initial shock and kind of entering like phase 2 of like, okay, how do we buy real estate? The sun's out. I hate being inside my condo with no balcony. And, like I don't want to renew my lease in August again and pay $100,000, right? Yeah. So we're definitely seeing a lot more activity. So Ashley mentioned, how's the market right now? Inventory's tight. Are you seeing appreciation or depreciation? Jeff, why don't you answer that first part, and I'll piggyback to answer the second question.
Yeah. So in terms of the market right now, the standard answer is that it's super local. So some areas are doing better than others, but overall, in Chicago and suburbs and nationwide, there definitely is an inventory shortage, which is causing statistically appreciation in the homes, combined with these incredible interest rates that I never thought we would see. And so yeah, the market's definitely doing well right now because of those two factors, in my opinion.
Yeah. So just to piggyback on that, when you think about a seller wanting to sell their home, they have to do an open house. They need people walking through their home. People are very sensitive to that right now because it's invasive for obvious reasons. So there's less inventory, less product, but the demand of buyers is increasingly high. So for every great property that hits the market, there's 3 or 4 people willing to offer on it. And some people are like, $399, $401, $402, $405, sold $410, but it might be listed at $499. Now, to Jeff's point, that could be hyper local, in certain pockets that might not be nationwide. But in Chicago, I think we've been somewhat insulated from what other cities might see as far as depreciation, because Chicago just tends to have a higher caliber of professional. We don't have people working in massive factories. It's not like Detroit where everyone goes to Ford Motor and they're making widgets and stamping. Like people just took their computer from the office and now they're working at home. So I think, saw less of a hit to unemployment, which means there's more buyers that are now back in the market because their leases are up. So the last question on rates are historically low. The government has implemented stimulus and different monetary policy to keep rates down, and they're also letting people with mortgages not pay their mortgage. So they don't want to see a housing market crash. The last recession I was in the business, it was predicated on the housing market crashing, and that was bad. This current financial situation we're in, the government's trying to, fend off a housing market crash. So they're keeping rates low to be a catalyst for new buyers and to help people refinance. And they're also letting people that went unemployed not pay their mortgage for up to 6 to 12 months. So I think that's also going to help us not have a big drop in values, because the people that are not paying their mortgage are going to get to stay in their home. They're going to have a little bit of a runway. But rates are hovering in the low 3% range right now, which is like insanely low. And they'll probably be that way for the next 12 months because it's unlikely the economy will recover. And until the economy recovers, rates will not go up. A question: will government force big banks to lower lending standards given the pandemic? What are the implications? So the governments can't force the banks to lower lending standards, but they can put pressure to keep the rates low. That being said, the banks hold the risk. If Chase gives you a loan, you're going to pay Chase every month. Chase has the right to say, well, listen, Fannie Mae says you can do 5% or 3%. You're going to pay me, I'm Chase, I want 20%. So the government cannot force the banks to loosen up their guidelines, but they can force them to lend at a lower rate. So right now, big banks are kind of tightening up to be more risk averse. We're still doing 3%, 5% down with no 700 credit requirement. So only time will tell. What the government is forcing banks to do is to keep the rates low and to allow people forbearance to not pay their mortgage payments. They're more focused on helping current homeowners than they are loosening up restriction. They're just focusing on rates to help new buyers. Jen had a question here from our Instagram. Do you think real estate market busy season is going to be delayed? What do you think, Jeff?
As you just alluded to, the market seems to be bouncing back very quickly and very strong. And I will piggyback, just going back to Ashley's question. The price point under 500K is where we're seeing incredible amounts of demand. Every listing that I've had that's under 500K, if it's a desirable location, has been moving quickly and receiving multiple offers. So the higher end of the market is definitely where we're seeing some of that depreciation. In terms of the market, though, for me, yeah, it feels like we're right back to where we should be. And I was actually looking this morning. I follow this tracker. It's called Showing Time, which is what realtors all over Chicago and the nation use to schedule showings. And as of today is the first day since the pandemic started where we've actually seen more traffic in the market than this time last year. And it was only by 1%, but I've been posting it on my social media as it's been uptrending. And yeah, today was the first day where we actually saw it surpass last year. So the market's doing well. To answer the question, though, the summer will definitely be like a spring market. I've seen a lot of landlords, apartment buildings delay leases where they push it back a couple months, giving renters more time to wait this out, but also allowing the building or the landlord to avoid having to fill a vacancy during a pandemic. So I think a lot of people have delayed leases, which is going to make the summer market strong. The fall is anybody's best guess. In my eyes, I feel like there's a lot of headwinds, frankly, between the presidential election, between a potential second wave, and obviously we're still, I don't think all the dust is settled, as you alluded to, Justin. I don't think the banks or anybody really knows what the world will look like 6 months from now. Just this past week, it was 80s and sunny, and we're finally allowed out of our homes. I think there's a lot of excitement, but in my eyes, I personally think the market will slow down in the fall. I know a lot of agents think it's going to be just running just because everything got delayed, but we'll see. I think it's going to be a bit slower in the fall, but we're going to see a lot of demand for the next few months.
What are you seeing with in-person showings versus virtual tours right
now? So when we were in the heart of the pandemic, I feel like we're kind of getting out of the eye of it. We were not able to do any in-person showing, definitely not on anything tenant occupied. For sellers who were motivated, who were buying a home simultaneously or moving out of state, those were the people who were still allowing showings. But there, as I mentioned, there's a lot of inventory that was pulled off the market for the reasons Justin explained, that sellers who have families, who have kids, who don't need to sell right now, they took their homes off the market and said, hey, I'm just going to wait this out. So the people who were showing or who kept their homes on the market were showing. But we definitely were trying to be cognizant of everything going on. So there was a ton of virtual showings, a ton of 3D tours. I know every agent was really trying to minimize the amount of people who went through other people's homes and minimize the amount of contact that they had with potential buyers.
So right now, May, heading into June, market's really busy. What percentage of your showings would you say are in person and virtual?
That's a good question. It's to be honest, I've still been doing a lot of showings, but I will say because of agents using more 3D tours, we've become much more efficient with our showings. So like I said, if somebody has their home on the market 90% of the time or 80% of the time, they're going to allow a showing. If a buyer is seriously considering buying it and they've done the virtual tour, they've gone through the 3D tour, they've looked at the listing enough in the photos, if a seller wants to sell, they'll usually find a way, unless it's tenant occupied. That's been the biggest obstacle, I would say, with showing, because legally it's not allowed. And as of this afternoon, we got an email hoping that end of May would be when we could start showing tenant occupied homes. And our note said that it's not, we don't know yet. So it's very possible it might extend into June that we can't show it. So any seller who's trying to sell a tenant occupied home is going to have some obstacles, because buyers want to see the home in person. And we've been seeing a lot of home sales contingent on seeing the home in person, which, for my clients or myself, I'd be uneasy taking my home off the market for a buyer who hasn't seen it and who has the offer contingent on seeing it.
Right.
So,
yeah, no, it's definitely interesting. There's a question about PMI. So if you understand how insurance works, or if you don't understand how insurance works, insurance is based off risk. So I like to give the analogy of when you're getting car insurance, they're looking at your driving record, they're looking at the make and model of the car, how many miles on it, the color, is it a convertible? There's all these different factors that equate to your risk. It's the same thing with the price of the car. It's the same thing with PMI. So PMI is based on, of course, the loan size, the down payment, your credit score, your debt to income ratios. So there's about 5 or 6 factors that go into what we call your annual premium. And so ultimately your PMI is going to be predicated on this number that we determine, this annual premium percentage, and then multiplied by your loan size. So if you have a $500,000 loan, your PMI is going to be higher than if you have a $300,000 loan, because the payment is predicated ultimately against the loan size. So hope that answers your question.
I actually have a follow-up that I was curious. I've heard another lender who I saw promoting this on social media, that he's actually advising buyers, if we scroll back to your example, this might actually be a good example of it. When you're looking at the breakdown when it comes to interest rate of putting 5, 10, 20% down, you'll notice that the interest rate is the same. If you're helping a buyer secure a loan and they have the option, what would you recommend, since the interest rate appears to be the same? And Is it just based off of the monthly payment? Is that the biggest piece?
Yeah, I think people need to really be focused on their monthly payment, not the rate. To your point, what's interesting is if you put down 5%, you're going to get the same rate as if you put down 20% because the rates are based on your credit. So having a 740 credit score and up, you get the best rates. Then your rates go up in 20-point tiers, 739 to 720, 719 to 700, all the way down to 620. Once you're over 740, you're getting the best rate, whether it's 5, 10, 17%, 19%. If you put down excessive down payments, you can get that rate down a little, 25, 30, 40. But between 5% to 20% down, the rate's going to be just about the same. So I think it's important for people to understand what their payment goal is, and then we kind of back into that number. How do we get your payment to 2,500 if that's your goal? What are taxes in this rate, in this neighborhood? What are assessments? And then can you put down enough? Some people have enough money where they can put 20% down, but maybe they don't need to because 15% down achieves the payment goal they want. And then they could keep that other money in the bank working for themselves. Someone just asked a question about an IRA. If you're borrowing at 3.3 and you could put the rest of your money in the market earning 8 to 10%, there's something to be said about that. So again, our job is to strategically advise you to find that balance between cash out of pocket and monthly payment, so you just feel this good equilibrium, because you don't want to break the bank, move into your home, and have no money for furniture, no money for various things. So kind of going back up the questions, if you have enough runway, is it a good idea to open up an IRA, dump disposable income into a tax-free on first home? Any warnings or strings attached? That's a great question. Generally speaking, of course, it's good to have your money working for you. IRAs, 401ks, brokerage accounts, there may or may not be tax implications. I always advise people just to check with their CPA. I'm not a CPA. I know there are definitely options for buyers to use that type of money without being penalized. So the short answer is yes, it's great to save and earn, but I would definitely consult with a CPA just to make sure that you're not missing any blind spots. Can you refinance a physician loan into a conventional loan? Yes, you can. You can refinance at any time, assuming you qualify for what you're looking for. So if you did a physician loan with no money down, and you may not have built up enough equity yet in 6 months, you may need to wait till you have 5% in your home in order to refinance. But you can always refinance if there's a better or more suitable option, literally within 6 months of purchasing your home. There's no set restrictions or penalties to refinancing. Skylar has a great question. Rule of thumb to calculate monthly payment size as a percentage of income. So there's a term that we use in banking called debt to income. How much of your income is absorbed by your debt? We want your mortgage payment. The government says we want your mortgage payment to be under 33% of your gross monthly income. So let's use a really easy number. If you make 10 grand a month gross pre-tax, we want your all-in housing payment to be around 3,300 or under. That's kind of on the high end. And a financial advisor might tell you, if you want to be able to save pre-tax, pay your bills, and then still save post-tax into your IRA or brokerage account, they might tell you to be closer to 20 to 25%. So in other words, keep your mortgage payment between $2,000 and $2,500 a month. So everybody has a different financial situation, but as a general rule of thumb, I would tell people, if you want to be conservative, stay around 25% of your pre-tax income, because you still have to pay taxes on that income. So if you gross 10K a month, you might only take home 7, right? Paying about 30 to 35%. But the government will let you go up to about 1/3 of your gross monthly income for your total housing expense. Good question.
I actually have one question to follow up on Jessel's question. I work with a lot of physicians. When a physician's deciding between doing a physician loan versus a conventional, is there any factor that you would say determines which one you would recommend?
It's a good question. It's circumstantial. It's circumstantial. Some people, it's super important. They just don't have enough money saved. They want to go low down payment or no down payment, which physician loans used to be no down payment. We don't have those anymore. Some banks might. We don't have a no down payment loan anymore. But physician loans are, sometimes it's like, what gets you in the door, right? Like, what's the path of least resistance? So it's circumstantial, but that's kind of my answer. It's hard to give an exact yes or no, because some people buy a home that's $1 million with no down payment. I think that's crazy, right? Some people buy a home and they put 5% down. I think that's a little more appropriate. I really wouldn't recommend no down payment, just because if there is a little bit of dip in the market, you know, you could owe $1 million and now your home's worth 980, you're upside down.
Yeah.
That's scary.
True.
So I always recommend a down payment. The only loan that still has no down payment is a VA loan. So if anyone's a veteran or has served, VA loans are also no down payment. So
I think Mallory,
anything that couple with separate finances needs to consider. Couples with separate finances. You know what? I think it depends if you're married. So assuming you're married, when a couple is purchasing a property together, we're looking at you as a cohesive unit. We're looking at your combined income, your combined debts. So we'll do a joint credit report, and your combined savings. The accounts may be different. You know, ultimately, you guys have to be comfortable and decide how much each of you are contributing for the down payment. But as far as, you know, anything to consider, not really. I don't know that there's any hindrance or any kind of like, watch out for this. But we look at you as a collective, you know, whether it's a couple, two buddies, you know, boyfriend and girlfriend, fiance, we're going to look at everything together, blended. And it doesn't matter who makes more, who makes less, who saved more. You're going to be on there 50-50 joint across the board. Whether it's mom co-signing for you or your husband or your investment partner, everything's 50-50, but you're looked at as a blended, cohesive, you know, applicant for a loan. Good questions.
yeah, those were good questions.
So just to kind of come to a conclusion here, I'm going to go to the end page here. So I thought we had our emails on here, but I guess not. Maybe at the beginning, have our emails on here. I mean, if any of you guys want to reach out to us, you know, Jeff and I would love to be a resource. Our emails on here, Jeff?
Yeah.
There they are. So that's how you can contact us. You know, a lot of people have questions. A lot of things are changing right now. Jeff, I usually tell people, if you're, you know, people ask how long out should I get pre-approved? I would say at least 6 months.
Yeah.
You know, just because you're not looking to buy in 2 months doesn't mean you can't kind of, what I say, get on the financial scale and weigh in. There might be something on your credit you didn't know about. We may look at your finances and think or want to strategize a savings plan so you're ready to go in the next 90 days. So getting pre-approved is complimentary. There's no obligation and there's no cost. So it's a good way for you to kind of see what's going on and just make sure you're on the right trajectory. And I don't know, anything you want to add to that, Jeff, in conclusion?
No, I think that's well said. And yeah, I agree. I think it never hurts to be proactive, and you never know what you'll learn by getting the process started. And then as you go, you'll just become that much better at everything.
Cool.
So.
All right, guys. Well, thank you so much. It was a pleasure connecting with everyone. I hope you guys found value, and look forward to being a resource. You know, we're here on your timeline. The market does change. We're in a very unusual time in just the economic kind of aspect of things. So what we say today literally could be different in 30 days. So it's best to get the education, not make any assumptions, and hopefully we look forward to, you know, eventually speaking with you guys.
Yeah. Thanks everyone for joining us tonight.
All right, we signing off?
Yeah, I think that's
all right.
all.
All right, take care, everyone. See you, Jeff. Talk to you later.